Your savings help you earn interest, and that interest becomes your income, and that income attracts a lots of taxes. But where taxes need to be paid, taxes can be saved. Some income sources attract a lower tax than others, and some income sources are also tax-free. Hello and welcome to another episode of Finance Fridays. In today's episode, we'll discuss how you can reduce your taxes on the interest earned from savings in bank deposits, FDs, and liquid mutual funds. Well, diversification is the key. Split your savings into FDs, bank account, and liquid mutual funds in a definite proportion. This will not just diversify your return on savings, but also diversify the tax on those returns. This setup will allow you to legally avoid or reduce your taxes. Let's understand this using an example in different scenarios. Suppose you are 35 years old and you have a saving of ₹10 lakhs which you want to diversify and make the most of that money. And you come under the tax bracket of 30%. Now, let's analyze how can you effectively split your savings in different scenarios. Scenario number 1. When you put all your savings into one bank account or one post office savings account. If you park all your savings into one bank account or post office savings account that pays 4% returns per annum, you will earn ₹40,000 in a financial year, out of which ₹10,000 will be allowed as deduction under Section 80 TTK, and the rest amount 30,000 will be taxable at the rate of 30%. That means 9,000 rupees of taxes. That makes your total post-tax returns to 31,000 and final returns on total savings to 3.1%. For those who don't know what is Section 80 TTA, this section allows a reduction of ₹10,000 on the interest earned from bank and post office savings account in a financial year. Scenario 2. When you put 10% into a saving account and rest 90% into an FD account. In this situation, you park ₹1 lakh into savings account, earning 4% per annum, and the rest of 9 lakhs into an FD, yielding 6% per annum. Now, you will earn ₹4,000 from your savings account and 54,000 from an FD by the end of a year. Out of these returns, ₹4,000 will be allowed as deduction under Section 80 TTA, and no taxes will be levied on that. However, the remaining 54,000 will attract 30% of taxes, that is 16,200, making your FD interest income post-tax to 37,800. So, in this scenario, your post-tax returns comes to ₹41,800, that is 4,000 plus 37,800, making your final returns to total savings to 4.2%. Isn't this final returns of 4.2% is equivalent to the returns received from savings account? These returns might not be adequate for you. So, are you wondering what should you do now? Well, the best option here is to move a part of your FDs to liquid mutual funds. You won't be able to avoid taxes on FDs. Even if you don't redeem any FDs in a financial year, you still will be paying taxes on FD interest. So unlike FDs, liquid mutual funds will be taxable only at the time of redemption, which might be in a year, which might be in 3 years, or which might be never. Plus, these liquid mutual funds have been generating a return of 6.5% per annum in the last few years. Let's understand this scenario now. Scenario 3. When you put 10% of your savings to a savings account, 50% of it to an FD, and 40% of them to liquid mutual funds. In this scenario, you will park 1 lakh to a savings account earning 4% per annum, 5 lakh to an FD account earning 6% per annum, and the rest 4 lakh into a liquid mutual fund with an annual growth rate of 6.5 per annum. Now, you will earn an interest of ₹4,000 from your savings account and ₹30,000 from your FDs. And your liquid mutual funds will grow by ₹26,000 per annum. Out of these returns, ₹4,000 will be allowed as deduction under Section 80 TTA, and no taxes will be levied on that. And FD interest will attract 30% of tax, that is ₹9,000. But on the other side, there may be no taxes levied on liquid mutual funds unless and until you decide to redeem it. That makes your post-tax 1 year returns to 51,000, that is 4,000 plus 21,000 plus 26,000, and final returns on total savings to 5.1%. So it is clear that this is the best split to increase your overall returns from savings and reducing your taxes without having to take extra high risk. So what are you waiting for? Diversify your savings and reduce your taxes on the income from those savings right away. We really hope that this information was helpful to you. Don't forget to like and share this video with your friends and families. Also, subscribe to our YouTube channel for such informational videos. Thank you for watching.